FM 90. Brought to you by Housing Finance Bank, a financial institution regulated by Bank of Uganda. Housing Finance Bank, we make it easy.
Your views, our interviews on Spectrum, Radio 1 FM 90.
A very good evening to you. Welcome to this edition of Spectrum on Radio 1 FM 90. My name is Kenneth Lukwago, your host this evening. And Spectrum is also coming to you live on 98.9 FM in Mbale and the other northeastern parts of our country. We are also live on our website, which is www.radio1fm90.com. You click on the icon with the word Listen Live. You can also find this radio station on DSTV, that is on audio channel 897. You can also find us on StarTimes audio channel 97. If you have a smartphone, you can also find Radio 1 on the different radio listening apps. Tune in, Afro Mobile, your TV channel, Radio Garden, and Stream Afrique. This evening, we'll be looking at the implications of the latest monetary policy statement issued by the Central Bank. Now, towards the end of last week, Bank of Uganda, also known as the Central Bank, issued its latest monetary policy statement after thorough analysis of the current local and international economic environment. Now, available information shows that the Central Bank has decided to revise its bank rate, which is known as the CBR, and the economic growth figures. It also explained the current inflation situation, taking into account the rise in commodity prices, and also explained the state of the Ugandan currency, the shilling. Now, the task this evening on Spectrum is to ensure that you members of the public understand the implications of this monetary policy statement and the advice the central bank is giving about the prevailing economic situation. In studio, I have Mr. Jimmy Apa, the Director, Economic Research Department at Bank of Uganda. Welcome to Spectrum, Mr. Apa.
Thank you, Kenneth, and good evening, listeners.
Right, Mr. Apa, last week, to be specific, on Thursday, you issued the latest monetary policy statement. But before we dwell into its details, let's begin by updating the members of the public. What is a monetary statement?
The monetary policy statement is a standard document that central banks use to communicate the change in monetary policy or the decisions on monetary policy to the general public, to the markets. In the case of Bank of Uganda, the bank sits after 2 months to assess both domestic and global developments and outlook in order to decide the direction of monetary policy. And so when the decision has been taken, it has to be communicated to the public and to the markets, the financial markets. And this is done through the monetary policy statement. So it's something that is very important. Everybody should be looking at it because what happens there affects your pocket directly. Thank you.
All right. Let's go through some of the key issues in this monetary policy statement. What exactly are you trying to communicate to the public?
The first thing we want to communicate to the public is the inflation developments and outlook. The outlook is the forecast of inflation, what we see as the general change in the price level at a given point in time compared to a period, say, 1 year ago. And the outlook, what do we see as inflation going forward in terms of, is it increasing, is it going to remain the same, or it's going to decline? We also communicate, because this is like a flip side of a coin, we also communicate economic growth. Inflation can lead to overeating, can result from overeating of the economy. And when the economy is overeating, it means it grows more than its potential level. And so that generates inflation. So if inflation is rising, economic growth is likely also to be generated, And so we have to communicate the growth aspects of the economy to the public.
All right.
And so we communicate economic growth and the outlook for growth and the risks to both inflation and economic growth.
All right. Staying with inflation, where are we? What are the figures now?
Right now we are at 6.3%. We are moving from about 4.9% in April. The figures I'm telling you is for the 6.3% is for May 2022. And we are moving from 4.9% in April 2022. And this is a big increase if you compare to the 2.7% in January 2022. Yes.
Is this a good thing? What exactly is going on? Let's paint a picture to the layman out there.
Yes. So what happens is that the rate at which prices are increasing overall in the economy, prices of consumer goods and services is increasing. Okay? Yeah, so at 4.9%, if a dollar was a shilling would buy for you one commodity, and the price the overall price increases by about 6.3%. It means now that that same shilling will not buy for you 1 unit of the other commodity.
You can buy a quarter of that commodity.
Maybe a quarter of that commodity.
So it means the situation is not good.
In other words, your purchasing power has been reduced. If you used to buy 2 vuveras of commodities in a supermarket, now you can only buy maybe half of a vuvera.
Well, there's been a debate about what could be actually causing the situation that we are in, the rise of commodity prices. As Bank of Uganda, one of the chief advisors to the government as far as the economy is concerned, have you been able to isolate these issues and probably to tell why we are in this situation?
So what happens is that COVID struck the global economy, and the whole economy went in total lockdown. There was no production. People were seated at home. And in fact, if you remember very well, oil prices went into negatives at the time because there was no demand. All the airlines were grounded. People were not traveling. Okay? And so, economies reopened. All of a sudden reopened. The U.S. stimulated the economy by around $2.something billion. Distributing this money to the households. Other economies add fiscal stimulus to help the economies recover from the COVID-19 slowdown. And so this boosted demand, and yet production was just picking up. Okay, so there was too much demand, which is unmatched by supply of goods and services. So that started to generate price increases. And then, as we were trying to see the economy is recovering, then the Ukraine-Russian conflict starts. And the Russian conflict actually disrupts supply chains. So now trade flows are disrupted. So
the original problem starts with COVID-19 lockdowns.
The reopening of the economy.
And the reopening of the economy.
Yes.
Okay.
Yeah, and so we see now prices escalating, which was a little bit cushioned if you look at it in terms of the transmission to the domestic economy, because we had in Uganda the agricultural sector was not locked down, production was going on, so prices remained low for some time. Okay, and then you have the shilling strengthening, and so the high prices in the global economy took time to materialize in Uganda. Yeah, but now we are seeing prices are rising, and as of May 2022, we saw a big jump, and all the components of the consumer baskets are increasing, and so the bank had to take appropriate policy to contain price pressures.
All right, and one of the steps you have taken is to raise the CBR.
Yes.
What is the CBR, and why has it increased? There was a time when I was following closely, and the Bank of Uganda was maintaining the same figure. Now, all of a sudden, poof, it has gone up.
Yeah, so the CBR is really a monetary policy tool used by most, in Uganda we call it the central bank rate. Other people call it policy rates. Yeah, so the central bank uses this tool to regulate demand in the economy. So when COVID struck in early 2020, the CBR was 8%. Okay, was 8% up to April 2020. So in order to support the economic recovery, the central bank, that is Bank of Uganda, had to reduce the CBR from that amount, from that level, to 6.5% and stayed it constant up to June 2nd, 2022. That was to help reduce the cost of borrowing, to stimulate demand for credit and help economic recovery. Okay? But but there is now this animal called inflation. Inflation, which is driven by supply side. It started slowly. In April, we saw that inflation was, in fact, some components of the consumer basket were declining. And so the central banks thought it wise not to raise the CBR at the time. But come May 2022, we are seeing a big jump in inflation, and all the components of consumer baskets is rising. All the components are rising. And so this is becoming a problem for inflation. I mean, for the economy. So the central bank had to raise the central bank rate to curb demand pressures until supply matches with demand.
What are the implications when you take this step and you revise the CBR and take it up? I've been hearing sometimes in the past that wherever you lower the CBR, the banks would not respond. Some people within the private sector would say Bank of Uganda is not effective. They need to actually ensure that the financial institutions they control respond to the decisions they take. What did you envisage as the implication? How does it save the situation by rising the CBR? What are the likely reactions we are supposed to see?
These are the implications. An increase in the CBR, first of all, will increase the returns on your savings. So if you have money to save, if you are a surplus holder of money, you take it to the bank and earn more interest on it. But also, the cost of borrowing is likely to increase. Okay, so that you compress demand. So when the cost of borrowing increases, you borrow less, you demand for less credit.
But
for consumption and for investment. And that should reduce aggregate demand and should check on inflationary pressures. But also, let me first finish.
Okay.
Also, when you raise the central bank rate, you are increasing the value of assets denominated in local currency, in shillings, relative to foreign assets, to assets denominated in foreign currency. And so you are attracting portfolio investment inflows into the economy, and that should support the exchange rate. Okay, so those are the implications of raising the central bank rate.
Well, let's look at one particular implication.
Yes.
The likelihood that interest rates will actually go up. We are in this economy where people have been struggling to look for cheap credit.
Yes.
And people are struggling to revamp their businesses because we are still under the COVID-19 shocks, and we are being told the numbers are again surging, which could probably also lead to other implications. We'll wait for the Minister of Health to actually come out. How then do you explain to a private sector player who wants to borrow that, look, we are raising the CBR and the interest rate is going to go up, so you cannot get cheap credit?
Yeah, it's we would be talking about,
in other words,
the net
you're
impact.
Stifling the economy, somebody would say.
Let's talk about the net impact. The net impact depends on what is growing faster. Remember, you are going to earn more on your savings, but you are also going to pay more for borrowing. Okay, so which one is growing faster? Okay, that will result in then you'll have to see the net impact. But at the moment, it's kind of a bitter medicine. Okay? It's a bitter medicine. You need to check demand pressures in the economy. Help the shilling stabilize against the dollar, because the shilling has been cushioning the price pressures. Otherwise, if we had also the exchange rate depreciating at the same time as commodity prices are rising, we'd be having inflation in double digits by now. So you need to support the shilling. You need these short-term pains for the long-term gain, because high inflation is also very dangerous for long-term growth. So it's kind of a bitter medicine. If you have malaria, you have to go through some little bit of pain, pricking to check your blood, and take bitter medicine for you to get well soon. And this is what we are trying to do for the economy.
Well, Spectrum on Radio 1 FM 90 or 98.9 FM in Mbale and the other northeastern parts of our country. Live on our website, www.radio1fm90.com. You click on the icon with the word Listen Live. You can also find us on DSTV audio channel 897, live on Star Times audio channel 97. We are also live on the different radio listening apps: TuneIn, AfroMobile, Your TV channel, Radio Garden, and Stream Africa. What you do, you go to your Google stores on your smartphone, download any of those apps, look for Radio 1 FM 90, and as long as you have an internet connection, you should be able to listen to us across this globe. You can also share your views and take part in this discussion by sending us a message via our WhatsApp line, which is 0703-090-090. I'll say that number again, 0703-090-090. In studio, we have an official from Bank of Uganda, that is Mr. Jimmy Apa. He's the Director of Economic Research, and we are looking at the implications of the latest monetary policy statement issued by the central bank. Well, you might be out there and closely following what is happening in the economy. Well, we have Bank of Uganda, one of the agencies that does advise government on the manner in which the economy should be handled. What do you feel about the commodity prices? Do you think Bank of Uganda has done enough to deal with this kind of situation? Mr. Apa, let's move on to another aspect in this monetary statement. You talked about the economy, the state of the economy. We already know about the commodity prices, we know about the inflation, but there's an issue about the growth of the economy. Some people talk about jobless growth, other people talk about the economy that is not growing in people's pockets. What's the perspective of Bank of Uganda about the healthy, the way our economy is, and the projections looking forward?
Yeah, so if you look at the global environment, global growth has been downgraded significantly for most economies, including where we supply exports. So that is likely to affect external demand. Okay? And then the other thing is that you see rising energy and non-energy commodity prices, which you are seeing on the palm prices already, and food prices going up. Okay, that is going to hit on your purchasing power. It erodes your purchasing power, it's on your income, and also affects consumer confidence, consumer and business confidence. And now with high inflation, the central bank raises the central bank rate, okay, from 6.5% to 7.5%. And that is going to tighten monetary conditions. In other words, credit will not grow as expected. And so these factors are going to affect economic growth. And so the central bank forecast came out lower than what we envisaged, at between 4.5 to 5%. This is lower than what we had forecast previously. Okay.
And what explains this? What explains why are we in this situation?
I have talked about weak external demand because the global growth is slowing down. I've talked about tighter monetary conditions. I've talked about rising energy and non-energy prices, which are likely to compress demand. Yeah.
So when you look at in terms of interventions, looking at the economy, we are even almost going into the new financial year. We have a new budget coming in. Any particular advice on how we can handle the economy, given that background that you've just shared? Where should we touch?
Yeah. So when you are faced with the supply side driven shocks like what we are seeing right now, you need to focus on your long-term goals, okay, than rushing, having a knee-jerk reactionary policies. These are populist policies like price controls, which are going to increase, cost shortages of commodities in the market. Policies like subsidies, which are going to benefit just a few rich people than the poor who do not use gasolines, SUV cars, Yeah, so focus on the long-term goals. And these are things that should diversify the economy so that when you are hit from one side, you can resort to the other side, okay? The government has this nice policy of BUBU, promote exports. I don't want to call it import substitution. It's more to promote more export. Try to increase exports. And that should help diversify the economy. They have programs to ease the cost of doing business in the country. Issues to do with the legal reforms, the land questions and all that. Those policies are likely to incentivize the private sector to produce more. Okay? And that is what the government should focus on.
All right, Spectrum on Radio 1 FM 90. We already have some few comments coming in, but at an appropriate time, I'll be asking Mr. Apart to respond to some of the comments that are coming in. But let's continue with the discussion and look at one other particular aspect, and that is the shilling. One of the issues you also reflected on in this particular statement is the state of our shilling, and it seems it's not in good health. What is the latest?
From early 2020 up to March this year, the shilling has actually been very stable and appreciating, driven mainly by prudent monetary policy by Bank of Uganda, adequate financial flows in form of FDI, loans to government, portfolio flows. These are short-term investors who come to buy government securities, remittances, inflows, coffee exports. So these factors really help support the shilling. But come March 2022, we started to, especially after the war in Ukraine, we started to see depreciation pressures. And now this has been escalated by the tightening global financial conditions. Because of high inflation in advanced economies, in the US, in the UK, in the Eurozone, these countries are raising their rates to contain inflation. And so when they raise their rates, the interest rate differential between Uganda and those countries declines. And so these short-term investors tend to pull out and go and invest in those countries. But what we are seeing in Uganda is that they are not yet pulling out. They are just taking positions. They are selling their securities and taking positions in the deposits in the banking sector or dealing in the swaps in the forex market. They are just trying to wait and see what the situation will be before they leave. But so one of the factors that caused Bank of Uganda to raise the central bank rate is to help support the shilling, to raise the interest rate so as to increase the returns on local currency denominated assets relative to foreign denominated assets, so that these investors can stay in Uganda. And so their stay is going to support the shilling. So far we are seeing the shilling as stabilized. Today there has been an appreciation on Thursday. Friday was a public holiday. On Thursday we saw a strong appreciation of around 30 shillings against the dollar.
Was that a miracle or is something that you did?
It is because of Bank of Uganda policy.
Which particular policy?
The raising of the central bank rate. That is starting to work. Okay? Today we saw an appreciation. In fact, before I came here, there was an appreciation of about 3 shillings against the dollar. And so the shilling is beginning to stabilize because of the Bank of Uganda policy. that it took on Thursday last week. Yeah.
There was no injection of some money in the economy or something like that?
Normally, the exchange rate policy is to implement a floating exchange rate. A floating exchange rate is that to allow the market to determine the price of money relative to the foreign currency. But the central bank can only intervene when there is excessive volatility to calm the market. And so, when the exchange rate was volatile, the central bank had to intervene by selling some foreign currencies to the market so as to stabilize the currency. Just to stabilize, not to determine the level of the exchange rate. Yeah, so there was a lot of intervention to stabilize the market, but also the policy of raising the central bank rate has helped stabilize the market.
Well, Spectrum on Radio 1 FM 90, as the discussion was going on about the state of the economy and the interventions that Bank of Uganda can do, there was something hinted on about the state of our reserves, and it's even a question that came at the press conference when the monetary statement was issued. Where are we in terms of our reserves? Are we safe? Are we within the acceptable limits?
We are at 4.6 billion. As at in April 2022. This is a huge increase from around 3.9 billion in the last financial year. With the intervention, which took about $200 million, we are at about 4.4 billion right now. Before I even check the actual number, it's about $4.4 billion. And this is adequate because we have these metrics where we want to see how much of next year's imports we can have just in case things does not work as we expected. So we have 4.2 months of import cover.
All right. Thank you very much for your submission there, Mr. Apa. We go for a break now. When we return, we'll look at some of the views that are coming in from the listeners, but also continue looking at the implication of the monetary policy statement that was issued by Bank of Uganda. Stay tuned to Radio 1 FM 90. We continue after these messages.
Spectrum on Radio 1 FM 90.
Nothing takes the stress out of the week like a delicious Sunday brunch at the Sheraton Kampala Hotel. Bring your family and friends, sit comfortably at your table and order your favorite dishes and drinks and enjoy lots of great entertainment for both adults and kids at 100,000 shillings with a 50% discount for kids. For inquiries, call Sheraton on 0312 322 499 or 0752 711 191 or email foodandbeverage@sheratonkampala.com.
We know these times have been challenging, but also believe that business shouldn't stop, whether trading inland or across borders. Come was a business with our trade finance services that are designed to make it easy for you. Talk to us today for bank guarantees, import and export financing, certificate and invoice discounting, import loans, commodity financing, contract, LPO financing, and more. Contact our trade finance team on 0704-252-833 or WhatsApp on 0790-542-262. Housing Finance Bank. We make it easy. Housing Finance Bank is regulated by the Bank of Uganda. Customer deposits are protected by the Deposit Protection Fund of Uganda.
Jennifer, I don't have waka. You busting eyes through me about my waka. Now come and see for yourself. See my waka that I got with Momo Nyabo.
Show them Waka with MTN Momo Nyabo. Simply deposit 20K or more on your mobile money for a chance to win 3 Toyota Succeeds and money to 2,000 lucky winners every week. We're giving away 24 cars and over 2 billion shillings of mobile money. Tune in to NBS TV and Bukaday TV every Thursday, 8:30 p.m. MTN. Terms and conditions apply. Beware of conmen. Only accept calls from MTN on 031-212-0000. For more information, call MTN Customer Care on 100 toll free. MTN Mobile Money Uganda Limited is regulated by Bank of Uganda. Spectrum on Radio 1 FM 90.
Welcome back to Spectrum on Radio 1 FM 90. We are live on 98.9 FM in Bali and the other northeastern parts of our country, live on our website, www.radio1fm90.com. You click on the icon with the word Listen Live. If you have a DSTV connection, look for audio channel 897. On Star Times, look for audio channel 97. You have a smartphone, look for any of the radio listening apps and look for Radio 1 FM 90. And you'll be able to listen to us. This evening, we are looking at the implications of the monetary policy statement issued by Bank of Uganda on Thursday last week, commenting on a number of issues: inflation, the central bank rate, the state of the Ugandan shillings, and the economy. In studio, Mr. Jimmy Apa, the Director, Economic Research Department at the Central Bank, Bank of Uganda. Mr. Apa, before we went for a break, we had almost gone through some of the key issues in the statement that you issued. But one big question with all this discussion, we have issues of the economy growing and so forth. People still complain and say the growth does not reflect in their pockets. What is the mismatch? Why do we see good figures sometimes but less in the pockets?
Okay, let me start with bad figures. Right now we have rising commodity prices, which erodes your purchasing power. It also dampens spending by consumers, of course, through the confidence. So that has also, and other factors like weak external demand, tighter monetary condition. The central bank has actually revised growth figures to between 4.5 to 5%. And so I'm not surprised. I'm surprised if you are not feeling it in the pocket. Okay? If you are not feeling it in the pocket, then you are very lucky.
What kind of person should be feeling it in the pocket? Looking at the state of our economy, where people who are in the money sector and those who are in subsistence, the bigger people, the majority of the people in the population surely cannot feel it in their pockets. And that probably is where the questions are coming from.
The people are feeling it in the pocket. If you are going to have, because right now, credit is growing at around 7-8%. It's supposed to, in a normal situation, it's supposed to grow at around 15 to 20%. Okay? And if credit is growing at a slower rate, then consumption and investment spending is low. It means production is going to be lower than what you would expect. And so, what I'm saying is that if people are not feeling this right now in their pockets, then they are very lucky. Because some people are beginning to feel it. And vice versa, if the economy is growing faster, you should be able to feel it in the pocket. You should be having better government services, large revenue collections, which should stimulate fiscal spending. Okay, you have better services by the government, less borrowing. All these factors should help you feel in the pocket. Okay, and if you look at world over, this is the best indicator that most economists, that actually all economists use to gauge activity, purchasing power, per capita income. Yeah. So everybody feels it in one way or the other in the pocket.
All right, let's get some feedback coming in from our listeners. Let me begin with the messages that are coming in through our WhatsApp number. We have a comment coming in from Subi Henry Mobiru, who is listening in from Makerere University. He says, I'm very disappointed with Mr. Jimmy Apa. The nature of inflation is neither due to increased aggregate demand, not money in circulation, but instead it's cost push. How appropriate are these policy tools like CBR? The phenomenon is not about to end, given the wrong diagnosis. Would you want to comment on that?
Yes. So what we are saying is we know that the sources of inflation are not demand. demand side pressures. They are cost push inflation. It's actually Henry Subi is very right. So if the sources of inflation are the cost push and they are short term.
Cost push, if you can break it down, what does it mean?
These are supply side bottlenecks.
Okay.
Because they are driven by supply chain disruptions, increases in the energy and food prices, food crops prices. These are factors that are not driven by policy.
Okay.
Yeah. So
the availability of the particular commodity.
Yes.
They are lesser, and therefore.
Yes. So Henry is saying that if inflation is being driven by demand, in other words, too much money chasing too fewer goods, that would the raising of the CBR would be appropriate. But what we are saying is that we started seeing inflation building up since November, and we came here in April and said, you know what? Inflation is rising, but not all the components of inflation are rising. In fact, at the time, some components were declining, like transport fares, like data services by these mobile networks. Data prices were declining. But come May 2022, we are seeing all the components of the CPI are rising. So inflation is starting to be broad-based. We are seeing nurses striking. I'm sure even in the private sector, workers have started to demand for higher wages. So what we are saying is that to avert this situation, it's better to contain that pressure by raising the central bank rate, so that supply adjusts slowly to catch up with demand. And this is painful because I told you it's like a bitter medicine. The cost of borrowing is going to rise, but also your earnings on savings will rise. The exchange rate will be stronger, and that should cushion the price pressures. Yeah, and this policy is appropriate at the time.
All right.
Yeah.
Another comment comes in from Bob, who is listening in here in Kampala. He says, Mr. Apa is dead wrong on Bubu and related policies. Though he meant to generate incentives like export growth, those policies are very unlikely to work given the current policy administration regime, amongst other key factors. That's a comment there that comes in from Bob. He actually thinks the policies you are talking about from Bubu may not help in the current situation.
Bubu is not a bullet, a magic bullet, a short-term bullet. You know, a bullet you.
And when we are talking about Bubu, that is import substitution.
Yes, it's a long-term. It's a long-term goal of the country. It's not going to help you with these current price pressures. It will take time to materialize. Okay? So, if he expects it to help in this current situation, then he's wrong. Yeah, it's a long-term government policy.
All right, let's go on the phone lines and see if we have some callers who actually want to chip in and contribute their views about this discussion we are having this evening. 0414 346 111, 0414 348 111, 0414 348 411, 0707 909 097, 0774 076 394. When you call in, please lower the volume of your radio set so that we can hear you loud and clear. Mr. Apa, let's look going forward, because we have gone through the pandemic and we have seen what it has done to our economy, and now we have these challenges of commodity prices. Interventions are normally short-term and long-term. We have discussed partly the short-term interventions, including the monetary policy tools that you have engaged as Bank of Uganda. But let's look at long-term. What would you advise the government to actually do as a lesson from these challenges that we have seen today?
Kenneth, first of all, monetary policy, raising the central bank is not a short-term goal, because its monetary policy works with a lag. And for a country like Uganda with the developing financial markets, which is not very deep, it takes up to around 18 months for it to really start to
cause an impact.
Yes. So it's not a long time. It's not a short-term goal. I would call it a medium-term goal.
Okay.
Yeah. So the government, because these are structural policies. Bank of Uganda has only one tool, which is monetary policy. So when it comes to other policies, then you are talking about the wider government, which is structural policies. So government has very many very prioritized areas in terms of structural policies. Have you heard about the goal to double coffee exports?
Mm-hmm.
Yes.
They have been talking about certain million bags.
This has been, we have seen coffee earnings rising to around $7.5 million. I mean, $750 million this financial year, from about $400 million. So that is working. In terms of reserves, the government is planning to have another oil reserve in Buloba.
That is for the other oil pipeline. That might be in 2026.
I'm not sure whether it's for the other, because they want to connect it to Lake Victoria, to move oil directly through Lake Victoria to Buloba, to increase the capacity of oil reserves. Okay. There are many other structural policies. Like if you look at this song of the parish development model, if you are going to inject 100 million,
you're calling it a song, yeah?
Yeah, it's because we are waiting for it.
And that's what people keep saying.
We are waiting for it.
That's what most people say. Economists
if you are going to inject 100 million shillings in every parish, clearly that is going to stimulate activity.
Will it?
Yes.
Okay, some people are saying the population is actually not ready. They might actually misuse this money. Have you seen any interventions to cause mindset change?
Why don't you first wait and see what will happen?
Because
the government has recruited
it has happened
chiefs.
before.
I mean parish chiefs and other staff to take care of that. How sure are you that they are not readying the population to take up this government intervention?
Oh, well, Mr. Appa,
yes.
I'll tell you, because even there's still confusion at the top. Even when you talk to government officials, they seem not to understand entirely what the parish development model is all about. Somebody is talking about money going to the people. Another person is saying parish model is not about money. It's about the aligning production.
Yeah, there are different aspects of the model. There's
still some level of confusion.
There are different pillars. Different pillars. But the pillar, which is financial inclusion, is to inject money to the population. Every parish is going to have money. Okay, so these policies are likely to stimulate long-term growth for Uganda. Okay, yeah.
So the outlook going forward from your side as Bank of Uganda is growth.
We are seeing growth returning to around 6, between 6 and 7%. That is the potential growth level for Uganda.
Well, Spectrum on Radio 1 FM 90, let's try to reach out to the people who are listening in to actually share their views with us. 0414-346 111, 0414-348 348 111, 0414-348 411, 0707 909 097, 0774 076 394. When you call in, please lower the volume of your radio set. And the other option of our WhatsApp number is also still open. You can share your views with us on 0703 090 090, and we'll be able to actually get you loud and clear. And Mr. Appa from Bank of Uganda will be able to respond to the questions that you put across. And we are looking at the implications of the latest monetary policy statement issued by the central bank, rising the central bank rate there by 2 percentage points, and also making a number of interventions that could see our shilling stabilizing, and also the issue of the economy. Bank of Uganda revising the figures there as far as the growth rate is concerned. What are your views? What do you think about this particular development? Well, as we come towards the end of the discussion, Mr. Appa, what would be some of the key messages that you want the listener out there, for instance, let me give you an example. Somebody has some good money on them and they were thinking investment. They were thinking maybe to put this money somewhere so that they can make more money out of it. How would you advise somebody who is in that category, somebody who is looking to invest? Is it time to invest, or it's time to put the money in the banks and make a kill from the interest rates you were talking about? What would you advise?
Yeah, you can put money in the bank to earn interest on it, but you can also invest, because with the policy, with the central bank rate working and stabilizing inflation, that stability should help you make a investment decision and actually invest, because with instability there's a lot of uncertainty, and in terms of planning you really don't know which price you are supposed to use to make important investment decisions. But you can choose either to put money in the bank and earn interest from it, or you can invest, because the economy is going, there is going to be macroeconomic stability arising from stabilized exchange rates and inflation. Yeah.
And probably let's look at some of the risks, the risks that we need to watch out as an economy going forward. Much as we had projected that there will be growth after the lockdown, some figures that you shared as Bank of Uganda shows that the economy was rebounding. Beyond what we are seeing now, Ukraine and the price situation, what are some of the other things we should look out as we go forward in terms of our economy?
We look both at the upside risks and the downside risks. I will start with the upside risk to growth. Investment in the oil sector. We have seen a significant rebound in FDI inflows, and for the next 3-4 years we are likely to earn close to $13 billion in FDI inflows to the oil sector. This should stimulate excessive growth in that sector and the overall economy. Okay? Yeah. And then when you look at the deliberate policies by government on agricultural production, the issue of doubling coffee production, the issue of the parish development model, this should stimulate economic activity, okay, beyond what we are seeing. But on the downside, we are seeing weaker. If we get weaker external demand for our exports, then we are going to earn less from exports, and that is going to affect growth. We have inflation rising in advanced economies, and these countries have started to tighten monetary policy. In other words, raising their interest rates, and this is causing tighter monetary conditions. Amid these problems in the developing countries, like most countries are already grappling with the debt vulnerabilities, and so their borrowing capacity are going to be affected, and that will lower growth. Okay, so we also have this Ukraine factor. We don't know when it will end, and that if it doesn't end soon, then we are going to see persistent supply chain disruptions and high prices, which is going to erode confidence and spending, and that should lower economic growth.
Now, earlier you hinted on the issue of...
Then we have the COVID. COVID is returning, and if it becomes a big problem that would require lockdown, that should really affect economic activity. We pray that it shouldn't reach that level. Yeah.
Well, earlier you hinted on the issue of diversifying our economy. Where do you see this playing a role in the growth and stabilization of our economy?
Yeah, a diversified economy is always resilient to shocks like the one we are facing right now. Okay, so we if you look at our export sector, you have coffee, which has been the main export commodity. Then you have tea, you have fish, maybe you have a few commodities. So why don't
your records have been showing gold as one of our key commodities also?
The gold we are exporting is actually almost equivalent to what we are importing. So this gold comes from outside by gold miners from different parts of sub-Saharan Africa. They add value to it into gold bars and immediately export.
Okay.
So the value addition is very, very small that remains in the country. Yeah, so that, of course, now we have to find a way of developing the local artisans to mine more, to produce more gold and take for processing, and that's when we shall start to earn more gold from Uganda. Yeah, but there are other commodities like food crops. Look at coffee alone. If we were to grow coffee as a main crop, how much would we export in coffee? Like Brazil, like Colombia, would beat these countries. Okay. Look at other crops like maize, like beans, where we have fertile soils. I mean, we could simsim. These are areas that the government could stimulate. Okay. You look at other sectors, agro-processing, services. There's a lot of potential in those areas that would diversify the economy, and this requires really policies. If you look at Bubu is attempting to diversify the economy, and it's not going to happen in one go. It's going to take some time because resources have to move from one sector to the other. There's going to be gainers and losers from these policies, and so it will take time to materialize. But this tells you that the government is moving in the right direction to diversify the economy.
All right.
Yeah.
From all this discussion that we have had, I will give you an opportunity to share the last key points with our listeners. Things that the public need to watch out from Bank of Uganda.
The first thing is that when you are faced with shocks like this, the supply side shocks, avoid knee-jerk reaction. And we want to call upon the media to support the government in this aspect. You need to tell people the disadvantages of price controls, the disadvantages of subsidies. Subsidies don't help the poor people. It only helps the rich. Price controls lead to rationing of goods, shortages. And so what we are telling people is that focus on the long-term goals. Do not lose focus on your long-term goals when you are faced with shocks.
All right.
Yeah.
Well, with that, we come to the end of Spectrum this evening. Let me thank you, Mr. Jimmy Apart, the Director of Economic Research at the Central Bank. Thank you very much for making time to explain a number of issues to members of the public. Thank you very much, our listeners, and especially those who contributed to this discussion. Spectrum will be back tomorrow. We will be doing the State of the Nation address. Yes, President Yoweri Museveni will be addressing the country through Parliament, and we'll be looking at some of the key issues he will hint on, and most likely the economy will feature among those issues. Stay tuned to Radio 1 FM 90. The news in English is up next.
Nothing takes the stress out of the week like a delicious Sunday brunch at the Sheraton Kampala Hotel. Bring your family and friends, sit comfortably at your table and order your favorite dishes and drinks and enjoy lots of great entertainment for both adults and kids at 100,000 shillings with a 50% discount for kids. For inquiries, call Sheraton on 0312 322 499 or 0752 711 191 or email foodandbeverage@sheratonkampala.com.
We know these times have been challenging, but also believe that business shouldn't stop, whether trading inland or across